you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to Morningstar. I'm Emma Wall, and here with me today to discuss investing in retirement is Morningstar's Dan Kemp. Hello, Dan.
Hello.
So we've reached the point in our Retirement Week special where we're starting to look not at how you build a pension pot, but what you do when you get there post-retirement, because we still have investment needs post-retirement, don't we?
Well, that's absolutely right. And retirement these days, of course, is becoming a much looser definition. Seldom do people just stop work and start drawing a pension. And so we have to remember when we're thinking about a post-retirement pot that it really came from a pre-retirement pot. And so really think about planning through retirement, not to retirement and then starting again.
A traditional post-retirement portfolio is invested predominantly in lower risk assets such as cash and annuities. And while this sort of more cautious stance definitely has importance, I think one of the things that's changed a lot since the portfolio theory was invented was life expectancy. So, with that in mind, what should we be making up our post-retirement portfolios of?
Well, retirement, of course, is an incredibly complicated time with different sources of incomes coming from lots of different places at different times. And so every investor is going to be different. But there are some key things to remember. The first is, as you're absolutely right to say, life expectancy's got much longer. People are no longer just investing for 5 or 10 years. They might be investing for 30 years, or even 40 years in some cases. And so it's important to have some long duration assets like equities, as well as shorter duration bonds and cash. Beyond that, people should also think about tax, because the way that you draw your money to fund your income will differ depending on the vehicle that you're using. So in the background, you should be always thinking about the most tax-efficient way of investing your money.
If we, for example, use the self-invested personal pension that many people use to build up their pension pot with, what happens post-retirement? Does that retain its tax-efficient status?
Well, it really depends on what you do with it, and of course those rules have just changed. There's been a massive overturning of old pension rules, and so if people haven't got advice from their advisor yet, then they really need to, because it's an incredibly technical area. But they should think about the way that they're going to invest that pot, because it will remain invested normally. People no longer have to buy annuities as they have done generally in the past. And so they're taking control of their pension income rather than passing it to someone else.
I think one of the things we should highlight as well, just because you're post-retirement doesn't necessarily mean that your risk appetite has changed. You still need to do the due diligence and make sure that these investments are the right ones for you, the individual.
That's absolutely right. That we can't assume that all people post-retirement are cautious or aggressive or rich or poor. It's about finding that mix of investment strategies that's right for you. As you know, at Morningstar, we've done a huge amount of work on this subject, looking at the idea of human capital and how that changes through time, and really planning not just for retirement, as I said earlier, but through retirement and taking your whole life circumstance into account.
Dan, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.